say this. The next segment that we need to discuss is valuation under customs. In this valuation under customs, we have first of all Incoterms. Incoterms refers to international commerce terms. There are various terms which can be given in the question, but ultimately what you need to do, you need to have a clarity. First they may give ex factory price. Ex factory price means the price prevailing at the exporter's factory gate is known as ex factory price. So that is price prevailing at exporter's factory. Then there is something called as FAS. FAS refers to free alongside price. Free alongside price means from ex factory price we need to add the transport charges. So we will get the free alongside price. Only the transport charges from where to where? From the factory gate to the exporter's port or airport. And thereafter if you add the loading charges also, that is loading into the vessel or loading into the aircraft, then it is ready for shipment, then it will be called as FOB price, free on board price. To that free on board price, when we add freight and insurance, from where to where? From exporter's port or airport to importer's port or airport, the freight and insurance when you are adding, that will be called as CIF price, cost, insurance and freight. This is the price prevailing at the importer's port. Thereafter, there will be some post-importation expenses like taking it to the importer's place, etc. But all those post-importation expenses are not forming part of value. So, in case of export, if you are exporting from India, what is the price relevant for payment of custom duty or what is taken as a value, FOB price? In case of import, we need to take CIF price, that is a price prevailing at the time and place of importation. Suppose if in exam they give ex factory price, then we need to add transportation charges, loading charges, freight and insurance, and you will get CIF price. Suppose if they give free alongside price, not yet tested so far, so they may give free alongside price also, then we need to add only the loading charges, freight and insurance. Suppose if they give FOB, we need to add freight and insurance and arrive at CIF. Why? Because CIF will be taken as the value in case of import. You can see here determined or determination of assessable value in case of import. First what we will do, we will take the ex factory price. What is ex factory price? Price at the exporter's factory, that we will take, okay. And thereafter determination of assessable value. So ex factory price we will take. Ex factory price means price prevailing at exporter's factory, add freight from factory to load airport or port, FAS, loading charges, FOB price. To that FOB price we need to make two adjustments, primary adjustments and secondary adjustments, then we will get the CIF price. So far what we discussed is only the secondary adjustments. So this freight and insurance when I am talking, that is only the secondary adjustments. Freight up to importer's port or airport, insurance up to importer's port or airport. But before adding the secondary adjustment, there is something called as primary adjustments, which is as per Rule 10 sub Rule 1. So Rule 10 sub Rule 1 is primary adjustments, Rule 10 sub Rule 2 is secondary adjustments. So 10 sub Rule 1 we have total 5 adjustments to be made. Then only you get the FOB price called as FOB price as per customs. But whatever FOB price that is given in the question is only FOB price as per invoice. So you need to take FOB price as per invoice and make these 5 adjustments to get the FOB price as per customs. What are those 5 adjustments? Adjustment number 1, selling commission. So commission which is paid to the agent, selling agent is known as selling commission. Who is selling agent? Exporter's agent or importer's agent? Who is selling? Exporter or importer? Exporter is selling, importer is buying. So the commission paid by importer to his agent is known as buying commission. The commission paid by exporter to his agent is known as selling commission. And selling commission generally paid by exporter, but if importer is paying, it's an indirect consideration to the exporter. So due to that reason it should be included in the value, that is selling commission. Thereafter container cost, packing cost. Generally who should bear this container cost, packing cost? The exporter should bear, but he is asking the importer to bear this cost. So definitely that should be included because all these are incurred by importer, which is like an indirect consideration to the exporter, so it should be included in the value. That is the first primary adjustment. Second primary adjustment is related to direct material, consumables or molds and dyes or intangibles. First, direct material, some raw material which is sent by importer to the exporter, or some consumables which are sent by importer to exporter, or some molds and dyes which are sent by importer to exporter, or some intangibles which are sent by importer to exporter. All these are used by the exporter in manufacture of finished goods, and that finished goods are being imported. Now definitely the exporter will charge only the conversion cost, he will not charge the full amount, because he got the raw material freely, he got the consumable freely, he got the intangibles freely, and he got molds and dyes freely. Due to that reason, that cost he will not recover from importer. But if you see logically, we need to pay customs duty on the value of the imported goods. So while determining the value of the imported goods, whatever money that exporter charges is only the conversion cost. But to that we need to add all the other things which are going from India to outside India. For example, the raw material is $10 and he is charging $15. Definitely in that $15, the $10 is not there. He is charging $15 only for conversion from raw material to finished goods. So this $10 also should be added. So 15 plus 10, it will be $25 will be taken as the value, assessable value, like that. So direct material, consumables, molds and dyes, intangibles, but these intangibles should be procured where? Procured outside India. What if the intangibles are procured in India? If the intangibles are procured in India, even though it is given by importer to the exporter, using that intangibles, if the exporter makes the finished goods, this will not be included. So they are giving a relief. So in order to encourage the importer to procure the intangibles in India, they are bringing this relief. Suppose if the intangibles are procured outside India, this relief will not be available. So definitely that will be including the value of the imported goods, because of which the value of imported goods will increase and customs duty burden also will increase. So supplied by importer to exporter, either free of cost or at concessional rate. Actual cost or apportioned cost should be included. What is apportioned cost means? For example, some molds and dyes are given by the importer to the exporter. Using that molds and dyes, they make some 1000 units. The cost of these molds and dyes is 10 lakhs. So 10 lakhs divided by 1000 units. So that will be absorbed into the cost. So that is called as the apportioned cost. Then next one, royalty license fee payable for imported product as a condition as per contract. So generally some royalty will be payable for every product that is imported, because that royalty is payable to the person who owns the IP related to that product, intellectual property of that product. So this royalty is also payable for imported goods only. For example, if I am importing an engine from a foreign manufacturer to use that engine in making an automobile in India, for that engine I need to pay a royalty, because the patent related to that engine is owned by some person. I need to pay royalty. That royalty is also towards the value of the imported goods. So definitely that should be included in the value, that is this. Royalty license fee payable for imported product as a condition as per contract. Royalty license fee proceeds payable for resale or disposal or use of imported goods. What is this? Like whenever for imported goods, anything that is paid, this is as per condition as per contract. This is for resale, disposal or use of imported goods. Both the royalty for the product, royalty for usage of the product, both royalties we need to. Royalty for the engine, and that engine if I am using and selling a car, because of sale of car, that foreign company, say for example I am importing an engine from Ford, and when I am using that Ford engine and making a car and selling, definitely the Ford Limited's car sales in India gets affected. So for which they are asking another royalty, one for royalty on the engine, another for usage of that engine in sale of car. So their profit is getting affected. For that also I need to pay royalty. Both the royalties will be included. Okay. So this is royalty for imported goods. This is royalty for usage of the imported goods. Then 5, all expenses incurred by exporter and charged to importer. And these expenses are incurred by the exporter. When he incurred before import, definitely whether it is a condition or not as a condition of sale, it should be included. But after import, example installation charges. These installation charges are payable by the importer to the exporter after import, but it is payable as a condition of sale. So definitely it will be included after export as a condition of sale. These are the 5 adjustments we need to make to get the FOB price as per customs. To that FOB price as per customs, we need to make the secondary adjustment. So we get the CIF price or assessable value under customs. This should be taken. And transaction value in case of import is the price prevailing at the time and place of importation. If there is a change in the contract price, say the revised price should be considered at which the goods are imported, because at the time and place of importation, whatever price that we pay to the supplier should be taken, not necessarily the invoice price. Say he may invoice it one value, but when the goods are in transit, the value might have been reduced. So we make a negotiation. By the time goods are unloaded, we pay the renegotiated price. So take the renegotiated price, don't take the price as per the invoice. That is this very, very important point. If there is any change in the contract price, consider the revised price at which goods are imported. Only if there is a change in the contract price, not change in the market price. Suppose if the market price increased, but we are paying only the contract price. What price we are paying? Contract price. Take that only. If the market price decreased, and we pay the decreased price, whichever price you pay, that only should be taken. Even if there is an increase in price, that is irrelevant for the purpose of computation here. Got it? Then adjustments to FOB, rule 10, that is this primary adjustments. Remember rule 10 of customs valuation rule. So whenever you are writing, you need to write that as per rule 10 sub rule 1 of customs valuation rules 2007. Okay. So commission is divided into two: buying commission, selling commission. Buying commission payable to buying agent. Who is buying agent? Importer's agent. So commission to importer's agent. What is selling commission? Commission paid to exporter's agent. This buying commission, who will pay? Definitely importer only will pay to his agent. It is his expenditure. Why importer's expenditure will be added to the value? If it is an indirect benefit to the exporter, it should be included in the value. Otherwise, importer's expenditure and all, we don't have to include in the value of imported goods, so to be excluded from value. But selling commission is payable by exporter to his agent. He only paid, so definitely it will not come in the value. When it will come in the value, it is payable by the exporter but paid by the importer. It's an indirect consideration to the exporter, therefore it should be included in the value. Is that clear? Then the other name for selling commission is local agent's commission, because which agent will be in India? Exporter agent will be in India, importer agent will be outside India. To represent the exporter, there will be one agent here. That agent is called as local agent. So the other name for selling commission is local agent's commission. Then see the next one. Suppose if material is sent by the importer to exporter, including capital goods or intangibles, but where this intangible should have been procured, it should be procured outside India, and that is used in manufacture of imported goods. Means when you import the goods, whether this is also part and parcel of the imported goods, yes, so therefore it should be included in the value at actual cost or at apportioned cost. Any other expenses recovered by exporter, if it is before import, definitely it should be included in the value and don't see anything. And if it is after import, so these expenses are recovered by the exporter from the importer after import, then check whether it is as per condition of sale of contract to be included in value. I gave an example of installation charges. If it is as per importer's request, like customization charges, for example, you imported the product and thereafter you are asking the exporter to do the customization. He sent a technician and he did the customization. Whether this customization is as per contract or not as per contract, not as per contract, it is as per importer's request. So therefore definitely it should be excluded from the value. It should not be included. Anything post importation expenses will be included in the value if it is payable to the exporter as per the contract, then only it should be included in value. Then what should be taken as the secondary adjustments? In secondary adjustments, first we got the FOB price as per primary adjustments, means FOB price given plus adjustments as given above. So therefore we will be getting the revised FOB price. This FOB price is as per customs. So FOB price as per customs. So FOB price, we have two types of FOB price. One is FOB price as given versus FOB price as per customs. This is FOB price as per customs. To that we need to add insurance and freight. How much should be taken as the insurance? If actuals are ascertainable, take actuals. If actuals are not ascertainable, take 1.125% of FOB. Ascertainable means at the time of filing bill of entry. If the importer knows how much is the insurance that he pays to the container, then it will be added. Suppose if he don't know, because the logistics operator has not yet raised invoice to the importer related to the freight and insurance, means insurance or freight is not ascertainable at the time of filing bill of entry, then in that case we will take a ad hoc amount. What is that ad hoc amount? 1.125% of FOB. In case of freight again divided into two: ascertainable, not ascertainable. If it is not ascertainable, always not ascertainable means again same, at the time of filing bill of entry I don't know how much is the freight that they are charging to me. Depends upon the consolidation agent or logistics operators, etc. So I don't know. So therefore what I will do, whatever is the FOB price I determine, not given FOB as per custom, means revised FOB. On that we need to take 20%. If it is air freight, ascertainable also, we need to compare between actuals and 20% of FOB, whichever is lower should be taken. Because air freight, too much air freight when we are including in the value will shoot up, because of which we end up paying high customs duty. That's the reason why they have brought in this actual or 20% of FOB, whichever is lower should be taken. Then any other freight we need to take the actuals if it is ascertainable. Then whenever we are taking the freight, that freight is not only the transportation cost, that freight includes ship demurrage charges. Ship demurrage charges means charges payable by the person in charge for anchoring the vessel in an outer space without bringing that vessel to the shore, that is to the port, is known as ship demurrage charges. This ship demurrage charges, which is payable by the person in charge of the conveyance, in turn recovered from the importer, so that is towards the transportation only, so it will be part and parcel of freight. Okay, thereafter when the ship is anchored in the outer space, the ship cannot come into the port, so the goods will be brought through boats, and these boats will be charging some amount called as light rate charges and bar charges, that is also towards bringing the goods up to our place only, part and parcel of transportation cost, so that should also be added. So see this, ship demurrage charges, light rate and bar charges, that is charges incurred for transportation of goods from the ship to shore. And handling charges in the midway, sometimes what will happen is that some delicate goods and all, they need to take extra care and caution. For that purpose they will be charging an extra amount for handling these goods. So these goods, like usually in the ship there will be some bottom cargo. In that bottom cargo they will be keeping all these delicate items, so that it will not get affected because of the waves, etc. and all. So they, for this handling charges extra they collect, that is also part and parcel of freight. But unloading charges in the midway, okay fine, it will be included, but in the import place, that is the location of importer, if they are doing unloading, that should not be included. So not at the place of importation, they will give unloading charges, nothing will be given, unloading charges will be given. So what is the assumption? Unloading means unloading in the importer's place, so don't include it. Okay, whereas if they give handling charges during the transportation or unloading charges in the intermittent port, like that they give, that will be part and parcel because it is during the journey. Okay, so not at the place of import, then it should be added. Then there is something called as normal demurrage charges. These normal demurrage charges or demurrage charges other than ship demurrage charges, we have two types of demurrage charges. One is ship demurrage charges payable by person in charge, that should definitely be added into the value under freight. Whereas normal demurrage charges, which is payable by the importer because of not clearing the goods on time, this demurrage charges should also be included in the value. No, this is post import, the goods are unloaded and it is not cleared within the time limit. What is the time limit? 3 days. Remember, 3 days. So within 3 days after unloading, the goods needs to be cleared. If not, they need to pay demurrage charges. To whom they will pay demurrage charges? Not to the customs department, but to the Port Trust of India or Airport Authority of India. That charges will definitely be excluded from the value because it is post import. That is, this demurrage charges paid or payable by importer, not included in the value. That is this freight. Then one more special point related to freight, that is, whenever we pay the freight and we compare it with 20% of FOB, and be careful, whenever we take 20% of FOB, it is from which place to which place? From the factory of the exporter to the port or airport of the importer. Okay, so let's try to understand this with an example. Yes. So that is from the port of the factory of the exporter. So at the exporter's factory gate, factory of exporter to the port of importation, again port of exportation. So from factory of the exporter to the port of exportation, there is some $50 as the freight and insurance. From the factory of exporter, freight and insurance or loading, freight and loading up to the ex factory price to the port of exportation, and say factory of the exporter we have somewhere like $4,000 as the ex factory price. Then what will be the FOB price? This is ex factory price here, port of exportation. So what is the FOB price? The FOB price will be $4,050. Again I am repeating, factory of the exporter, the price prevailing is $4,000, and when you add $50, So that is freight and loading. We get the price at the port of exportation called as FOB price. That FOB price is 4015. And again, from the port of exportation to the port of importation, we need to get the freight and insurance. And freight and insurance not ascertainable, okay, or freight is not ascertainable. Freight is not ascertainable. Freight is not ascertainable. Then what should be taken as the freight? That is the question here. What should be taken as the freight? What should be taken as the freight? When the freight is not ascertainable, usually you will take 20% of FOB. So what is the 20% of FOB? 20% of FOB. What is the 20% of FOB? 4050 into 20%. That will come to 4050 into 20%. That comes to $810 will be taken as the freight, correct? Now, this is correct if you are writing CMA final exam. You are writing CMA final exam? No, CA final exam, na? Correct. For that reason, you need to do one extra adjustment, minus already in FOB, already considered in FOB. What is it already considered in FOB? $50. This $50. Why like that? Because this $50 is also part and parcel of freight while you take 20%. What is the meaning of the 20%? This 20% freight is from the factory gate of the exporter. We need to take 20% of FOB freight is from the factory gate of the exporter. That's why we should separate it. Then what is the remaining amount that should be taken? So freight, what is the freight to be considered? The freight to be considered will be 810 minus 50, that is $760. And insurance, insurance is ascertainable. Say insurance is somewhere like $20. Now what will be taken as the assessable value? CIF price or assessable value? CIF price or assessable value equals to, what is the FOB that we got? 4050 plus freight will be 760 plus insurance, that insurance will be 20, that will be taken. So 4050 plus 760 plus 20, that will be 4830 will be taken as the CIF price, okay. So therefore this is the area which you need to be careful about, and when you need to do this only when you have ex factory price. When you don't have ex factory price, this problem will not arise, okay. Only when ex factory price is given in the question, and then we are taking, and freight is not ascertainable. Ex factory price is given in the question and freight is not ascertainable. In these two cases, this adjustment, extra adjustment will come. Then suppose, what if it is airways? What if it is airways? Again the same story. So we have ex factory price, we have ex factory price, and that ex factory price is same $4,000, and we have price at exporters airport, and we need to get price at which place? Importers airport. We need this price, okay. Now ex factory price 4000 is given. From this place to this place we have got say some $50 as usual as freight and insurance, and therefore price at exporters airport, what is the price known as? FOB price. That FOB price is 4015, no change. Again from exporters airport to importers airport, there is some freight and insurance, and insurance is given. How much is that insurance? Same $20, and freight is also given, and that freight is somewhere like 50, that freight is somewhere like $50, okay. That freight is like $50. Now what should be taken in this case? What should we do in this case when the freight is $50? Now we need to compare. What is that comparison that we need to make? Actual or 20% of FOB, whichever is lower. So what is the actuals? 50 is wrong answer. 50 is wrong answer. 50 cannot be taken as the freight. Okay. So for the sake of, like as both are 50, you may get confused between which is 50, which is that other thing. Let me take this as 60 so that you will get a comparison. And here if you see, what should be taken as the freight? What should be taken as the freight? Even though actually is ascertainable, I need to take a comparison, that is actuals. What is actuals? Actuals is 110. How 110? The moment when we take 20%, we are comparing from the factory gate. So therefore $50 plus $60, that will be taken as $110, or B, 20% of FOB. What is 20% of FOB? 4050 into 20%. Okay. So 4050 into 20%, that will be 810. So actuals are 20% of FOB, whichever is lower. Whichever is lower. Whichever is lower is only 110 minus already considered in FOB. Already in FOB. What is that already in FOB? $50. So therefore we will be taking, freight as 60, actual itself. Sir, only directly we can take actuals now, sir? No. Sometimes what will happen, the 20% of FOB will be less than this. The 20% of FOB may be less than this. Then in that case it will change. Okay. And what should be taken as the assessable value or CIF price? CIF price or assessable value, simple, that is 4000 plus, 4050 plus, we will be having freight 60 only we will take, and insurance will be 20, that is 4001. So 60, 70, 80, 130. Okay. 4130, 4050 plus 60 plus 20, 4130 will be taken as the CIF price or assessable value. Sir, then always actual will be equals to like this? No, it will change. Suppose if the actuals instead of 60, what if it is somewhere like 850? If the actuals is 850, then when the actual is 850 plus 50, 900. 900 or 810, whichever is lower will be 810. 810 minus already in FOB 50. So 810 minus 50, that will be coming to 760. So 760 will be taken as the freight. The method don't change. The format don't change. You need to stick on to the format. Again, when we will do this additional computation, again when X factory price is given, even though it is freight, but which freight it is? Air freight. Which freight it is? Air freight. So in these two places, that is whenever the X factory is given and it is a normal freight, but the normal freight is not ascertainable, or X factory price is given and it is air freight, then we need to do this way. Okay, that is the computation to be taken, and you can see this related discussion here. So customs valuation, when the X factory price is given, so have a look into that. What is it they are telling? First branch, you see, first branch, freight from exporting country to India is available. Then if it is air freight, available, freight is available, but it is air freight. But what we need to do? 20% or actuals, whichever lower should be taken. While taking actuals, clearly see there, while taking actuals, what we need to do? While taking actuals, we need to take from the factory gate of the exporter. Okay, so while taking actuals, we need to take from the factory gate of the factory to importers airport. What is a factory to importers airport? That is 50 plus 60, 110. Okay, then or B, 20% of revised FOB, whichever is lower, minus freight from factory to load airport minus loading charges, that should be separated. Okay, so that should be taken as the air freight. If it is other freight, there is no 20% comparison. So as there is no 20% comparison, we will take the actuals. When freight is from exporting country and it is not at all ascertainable, when it is not at all ascertainable, by default you need to take 20%. Wherever 20% comes, the same story again, that is freight at the rate of 20% of revised FOB minus, we need to separate right from which place to which place? Factory to the load airport or port minus loading charges in the load airport or port. This is something definitely they can be testing while doing the computation related to value, either in IBS or in like normal IDT paper, anywhere. But this is something which is so crucial. Please remember this for exam purpose, and trust me, this is the way in which valuation needs to be done. And if you solve the study material question or in our solved workbook also, you will find it as to whether it is correct or not then. And sir, what about problem solving, sir? So mighty 50 questions I need to solve. So but my objective is first to complete the portion. So first let's complete the portion, and then if time permits we will solve, otherwise I will post that video separately. But my objective is to, because amendments are also there, and amendments also I need to explain you clarity with a clarity, and for that reason please let me focus on doing this. But wherever really required, a computation is required to make you explain, I will write this small concept illustrations to make you understand. Okay, now say this customs valuation rules 2007 in case of import. First we need to go by the transaction value. What should be taken as the transaction value? That's what we have seen, CIF price prevailing at the time and place of importation. But sometimes the transaction value will be rejected when, if the transaction is between related parties. So related, or if the price is not sole consideration. You can see there, above adjustment shall be made as per rule 10. Customs officer shall not have any doubt about the truth and accuracy of the declared value. Underline, shall not have any doubt. Shall not have any doubt. If the customs officer is having any doubt about the truth and accuracy of the value, can the customs officer reject the value? Yes, he can reject the value and he will do the computation. Remember, in customs, this valuation rules and all will not be done by the importer. This valuation rules will be done by the customs officer. But in GST, we have valuation rules. In GST also, rule 28 related parties, rule 27 price is not sole consideration, etc. But that will be done by the taxpayer in GST, but here it is not done by the importer or exporter, it will be done by the customs department. So customs department may reject the value which is declared by the importer, that is transaction value, on account of truth and accuracy, suspicion about the truth and accuracy. In that case, the customs officer only should determine the value. Or another reasons. What are the other reasons? 4 conditions should be satisfied. Unrestricted sale means, suppose if the exporter is putting any restriction on sale of these goods in India, then customs officer will invoke valuation rules. Number 2, unconditional sale. If the exporter puts any condition on us to sell this, then also customs officer will invoke valuation rules. Then if it is unrelated persons, what if it is related persons, then also this transaction value not applicable. And price must be sole consideration. What if price is not sole consideration? Means apart from price there is some other consideration flowing from the importer to the exporter, then price is not sole consideration, then also valuation rules will be invoked. Okay, so what are the 4 conditions for transaction value? It should be unrestricted sale, unconditional sale, unrelated sale, and price must be the sole consideration. Anyone fails, the valuation rules will come. What is that valuation rules? Customs valuation rules 2007. First one is T, that is transaction value. Next one, TISDCR is what you need to remember. T for transaction value, I for identical goods, yes, TIS, S for similar goods. Then next we have DCR, D for deductive value, C for computed value, and last residual value or best judged value. First we will see identical goods. So far we understood the transaction value. If transaction value fails, only identical goods will come. All these are valuation rules 2007. First one, transaction value, is rule 3, and then rule 4 is identical goods. What does it say? Identical goods are also imported goods, and these imported goods have the same physical features and quality. It should be same to same, then only it will be called as identical. No minor modifications, also exactly the same, the replica kind of. And it should also be imported, and it should be imported from the same country. For example, the goods in the question for which the valuation is invoked is imported from Germany, and this comparable good should also be imported from Germany. You can see imported goods, same physical features and quality and reputation, produced in the same country in which goods being valued were produced by the same person, preferably not compulsory. So this 4th point alone is optional, produced by the same person. For example, I am importing LG washing machine and you are importing Samsung washing machine. I am also importing from Taiwan, you are also importing from Taiwan, and same to same, everything same. That is, I am also importing top load, you are also importing top load, same capacity, same features, everything. Can we take that as identical? Of course we can take as identical, because that is also imported, same physical features and quality, same country, but not same producer. It's okay, fine, but it can be taken as identical goods. If it is same producer, well and good. If not, also it is fine. That is this. And we need to make 3 adjustments. Adjustment with respect to difference in the quantity. For example, I am importing 10,000 units, you are importing 5,000 units. Now, your product is taken as a comparable product. Had you import 10,000 units, you would have got a better discount price. So that should be taken as the comparable value. Means comparable should not be like just like that comparable, it should be directly comparable. For that reason, adjustment should be made with respect to difference in quantity. Say for example, I am importing 10,000, you are importing 5,000. Had you import 10,000, you would have got a discount of 10%. Means whatever is your price at which you have imported minus 10% should be taken as the comparable value. Then next, difference in transportation cost. For example, I am importing to Chennai and you are importing to Surat, and from Surat to Chennai there will be extra transportation cost. Whatever cost at which you have imported plus freight from Surat, usual freight and insurance from Surat to Chennai will be added, then only it will become directly comparable. Thereafter, difference in the commercial level also we need to adjust. For example, I have imported from manufacturer, but you imported from a wholesaler, and the usual margin made by the wholesalers in that country is 15%. Then what you need to do? I need to take the price at which you have imported and minus 15%. When I do that, I will get the directly comparable value. What are the 3 adjustments? Difference in the quantity, difference in the transportation cost, and difference in the commercial level of importation. And if I get multiple transactions like this, so which should be taken? The lowest value should be taken. Okay, this is about transaction value of identical goods, an untapped area. So definitely I am expecting a question by including these adjustments. They can make some adjustments and they can coin some questions on this basis. Okay, so there is a possibility of testing question on this in these lines. Okay, now say this, rule 5. Assemble value equals to transaction value of similar goods. When identical goods fails, we don't have same kind of goods, same to same we don't have. So then in that case we go for similar goods. In similar, what will happen? That is also imported goods, but commercially interchangeable with the imported goods. For example, a top load washing machine can be compared with a front load washing machine, and a double door refrigerator can be compared with a single door refrigerator, like that. So it is the same but commercially replaceable. Then in that case we need to make an extra adjustment. What is that extra adjustment? Difference in the engineering work and development work, material, etc. and all. So because say for example, double door refrigerator and a single door refrigerator will definitely have a difference in cost. So a single door refrigerator is 10,000 rupees usual price, means double door refrigerator usual price will be somewhere like 15,000 rupees. So that 5,000 rupees adjustment we need to make. Got it? For example, I am importing single door, you are importing double door. Whatever is the price at which you have imported, I need to make one extra adjustment, that is usual price difference I need to reduce. So I will get what is the price at which single door refrigerator you can import. Okay, so imported goods, commercially interchangeable, same country, same producer preferably, and 4 adjustment: difference in quantity, difference in commercial level, and difference in freight, and extra difference in material engineering work. Here also if we have more than one price, we need to take lowest of that value. Then suppose this is rule 3 transaction value, rule 4 identical goods, rule 5 similar goods, rule 6 says if you are unable to determine identical goods or similar goods, means such kind of goods are not imported, and when it should have been imported at or about the same time. That is the words that they are using, at or about the same time. Okay, so identical goods also at or about the same time, and similar goods also at or about the same time. Okay, so you can just write that at or about the same time, at or about same time, at or about same time, and even this is also at or about same time, at or about same time, means nearest time, maybe 1 week, 5 days, like that. What if we don't have anything of that sort? Then we need to determine the value as per rule 7 or rule 8 in any order. There is no priority there. Either we can go for deductive value or we can go for computed value. We need to select, that is importer needs to select, or and importer whenever he selects, that value can be taken. And computed value. Computed value means what will happen? It's a top down approach. Top down approach means, so we will see the raw material cost that is prevailing in the exporter's place, and we will add every other cost, raw material, labor, overheads and processing cost, administration cost, and then even we will add his selling profit margin, that exporter's profit margin, and then fight from factory to the load airport or port, thereafter loading charges, then freight and insurance, everything we add to bring it up to our place. So all costs will be added. Post importation cost we will not add. All pre-importation costs including his profit margin, when we are adding, we will get the price prevailing at the time of importation. This is computed value method, a top down approach, whereas deductive value is a bottom up approach. In computed value, see what is happening: cost of production and then profit and general expenses, freight and insurance referred above, whatever freight and insurance that we have seen. Whereas deductive value, in deductive value it's a bottom up approach. We see the selling price in India. Selling price in India immediately after importation, that is we are importing and we are selling. You take that price and work backwards. All post importation expenses you take out and customs duty also you take out. Now you will get price at the time and place of importation, that will be taken as the value. You can see here selling price of imported goods or identical goods or similar goods to unrelated buyers minus post importation expenses. Post importation expenses including customs duty. Now you will get price at the time of importation, that is deductive value. And this time I don't know, my intuition is telling either deductive value or computed value, one question will be asked. Okay, so for 4 marks there is a chance out of these two, because long time they have not touched it and regular question on valuation they have been asking. Out of these two any one question is possible. Then rule 9, if it is not coming don't scold. Rule 9, so because I am having a fear nowadays, and previously and all it used to happen, I used to tell it used to come like that and all, but now things are not like that. So November exam paper after that, and literally students are, after exam their frustration they are showing on me, as if who asked them to follow only me. They should have read and went na fully. Sir, none of the question what you said came. Whatever you gave in Mighty 50 it did not come, boss. It is like these are all the overall questions. If you trust that only and go and tell, then I would have released the question paper, collected 1 lakh from student. Na? My life would have been settled, correct? So rule 9, assessable value equals to best judged value, and this is residual value. When this residual value will come into picture, in case when all these fails, the assessing officer will determine. But when he is determining the value, there are few points that will be kept in mind. What is that? First, assessing officer should not determine the value based on the selling price in India. That should not be taken as the value. And selling price of the goods in the domestic market of the country of exportation also should not be taken. So first, the selling price in India should not be taken as residual value. The selling price in their country should not be taken. The sale price of goods for export to country other than India, third country price also should not be taken as value, and cost of production of identical or similar goods, unless as per rule 8, highest of two values, minimum custom value, arbitrary or fictitious values. Next, one line summary is simple, that is they need to scientifically determine the value, and that scientifically determined value should be given to the importer, and if importer agrees to that value he will pay, otherwise he will go for appeal against that value. This is known as self assessment under custom, section 17. As per section 17, what will happen? The importer will file the bill of entry. When he files a bill of entry, he declares the value. When he declares the value, customs officer will tell no, this value is not acceptable, like that he will reject the value and he will do reassessment. When he do the reassessment, he will follow any of these methods. In that methods, suppose if he goes for residual value and he specifies one value, that importer may or may not agree to that. If the importer agrees to it, he will pay the customs duty. If importer is not agreeing to it, what he will do? He will pay the, he will ask them to pass the order. But still pay the duty under protest. That is called as payment of duty under protest, because he need this goods, he need his goods to be taken to his place. So that's the reason why he will pay the duty under protest, but he will ask the officer to pass a speaking order. Against the speaking order, he will go for appeal. What is the time limit within which the speaking order should be passed? Within 15 days. within 15 days it should be passed. That has a connection from here to self assessment. You can see self assessment which is in page number 256. Page number 256, self assessment under customs, section 17 of Customs Act. These two are connected because what happens is that first bill of entry will be filed by the importer. So an importer entering any imported goods under section 46, that is bill of entry, or exporter filing shipping bill shall self assess the duty. So they will declare some value, they will do the computation and they will file the bill of entry. And thereafter this bill of entry will be taken up for verification by the proper officer. When they take up this verification, so it is like a scrutiny assessment in income tax and GST. They take up the bill for verification, and not all bills will be taken up for verification. There is some risk criteria. So based on that they will verify, and if they are of the opinion that the value declared by the importer is not correct, then they do the reassessment by the proper officer if this assessment is not done correctly. And importer has two options. Option number one, importer may agree to it and pay the same by amending the bill of entry or shipping bill. So they will do the amendment based on the value given. I need to amend it and I need to file. Amending the bill of entry does not mean new bill of entry is filed. For the original bill of entry itself, I am doing just the amendment, okay. Whereas in case the importer is not agreeing to it, sir, no, I don't want to pay this. Is there any alternative for him? Yes. That is a speaking order for reassessment will be passed. To be passed unless the importer agrees with the reassessment within 15 days from the day of reassessment of bill of entry or the shipping bill as the case may be. Then what will happen to the goods imported? Two options again. The imported goods may be kept in the warehouse without payment of customs duty, or it may be like paid customs duty under protest. They will pay customs duty under protest, and based on the speaking order they go for appeal. When they go for appeal, what will happen after that? Maybe appellate authority, that is commissioner appeals, or CESTAT. For customs it is CESTAT, or High Court or Supreme Court will tell that, okay boss, whatever you have paid under protest is wrong and you need to pay the lesser duty only. Now the excess duty is paid, that they will get as a refund, and that refund is in section 27. That refund is in section 27. You can see that refunds under customs, section 27. So customs duty paid in excess. In this customs duty paid in excess, including the payment of duty under protest, you know what? Usually when you pay the customs duty in excess, you have to make application for refund within 1 year. But in case of protest, payment of duty under protest, that 1 year time limit is not applicable. 1 year from the relevant date, usually payment. This is the time limit. But you can see below, that is application, refund application within 1 year not applicable. Refund application within 1 year not applicable if duty is paid under protest. Means time limit is not there. Even after 10 years, 20 years also, you can make the application and they need to grant the refund. Is it clear? So that's how these things are connected. What's there in learning everything normally? Let's connect everything, because ultimately in exam, they can ask anything. Got it? Next. So coming back to this, so best judgment assessment, hope you got the clarity as to how things will work, okay. Next we have valuation in case of export. In case of export, what should be taken as the assessable value? Very simple, FOB price should be taken, the price prevailing at the time and place of exportation, that is FOB price, whether any adjustment is required or adjustment not required. Adjustments are not required. So means primary, secondary, nothing, whatever FOB given, that should be taken. However, this value declared by the exporter may be rejected by the officer, same self-assessment concept. So he will file a shipping bill, in that he will mention whatever is the value and customs duty payable, but that value may be rejected by the customs officer on account of overvaluation. So usually import case on account of undervaluation they will reject. In case of export on account of overvaluation they will reject. Why do they do overvaluation? In order to claim the export benefits. There are a lot of export incentives which they will be able to claim. For that reason they will declare it more. So assessable value equals to transaction value. Proper officer should satisfy that the declared value is genuine. Even in case of related party, transaction value may be acceptable. And suppose if they are rejecting the declared value, then what will happen? Here we have only 3 rules. One is like, kind and quality, computed value, best judged value. Like kind and quality means comparable price, like identical, similar. Okay, so here we are exporting goods. Say for example, I am exporting one car, and when I am exporting a car, so that value whatever I am declaring is rejected by the customs officer, because customs officer is of the opinion that it is sold to a related person. Because if you see lot of foreign car manufacturers are opening up their manufacturing units in India, and from India the cars are being manufactured and it is exported to their holding companies there. Definitely it's a related party transaction. In case of related party transaction, the officer may tell that this is not the correct value. Then in that case we need to see the comparable price. What is a comparable price? That should also be exported only. The comparable should also be exported, and same physical characteristics, quality and reputation, same, everything it should be same. For example, ours is a diesel engine, that should also be diesel engine. Ours is now say 1500 cc, that should also be 1500 cc, like that, same physical features and quality and reputation. Then produced in the same country in which goods being valued were produced, same, and produced by the same person, preferably, not compulsory. So which means, can we take Mahindra to Tata? Yes, Mahindra is exporting and Tata is also exporting. So can we do the comparison? Of course we can do the comparison. So that is it, produced by the same person, preferably, not compulsorily. Next, adjustment shall be made with respect to what? Three adjustments to be made. Difference in quantity. So what is the difference in quantity? For example, I am exporting say 100 units and they are exporting, comparable is exporting 80. Now what if you export 100? Like that comparison. Difference in transportation cost. Say for example, I am exporting from Mumbai port and you are exporting from Kochi port, then Mumbai to Kochi there will be some freight difference that needs to be adjusted. Difference in commercial level of exportation. Again here also, what if we get more than one price? The lowest of that price should be taken. Then assessable value equals to computed value. So this computed value is like import, we have computed value, na? But only in Indian context we will do this. That we are doing in the exporters context. This we are doing in exporter context who is in India. So that is normal cost of production, profit and general expenses. Why freight and insurance we will not add? Because in case of export we take the FOB price, not the CIF price. In case of import, as we take CIF price, so that's the reason why we need to add the freight and insurance under computed value. But here in computed value we will not add all those things. Then best judged value. Best judged value means a value determined by the customs officer based on the principles of valuation. Then next one, when they are treated as related. So related definition, you remember, easily you remember the related definition, that is family scope. Okay, related definition you remember like this. So family scope, family scope, family scope. Okay, and in GST and in customs. In GST, what is the meaning of family? Family is defined. What is that? Spouse and children, whether or not dependent. Spouse and children, whether or not dependent. This is the meaning of family, plus all others, brothers, sisters, parents, grandparents, in-laws. No, in-laws are not related. Okay, in-laws are not related, they are not family. And brothers, sisters, parents, grandparents, that too when? If they are wholly and mainly dependent. If they are wholly and mainly dependent. So this is in GST, but in customs we don't have family definition. So family is given, but family definition is there. I mean, not defined, but it is there in customs. Not defined, but in the meaning of related. In the meaning of related, both in GST as well as customs, we have family. Then scope. In that scope, S is same. That is sole selling agent. We have in both the places, GST as well as customs. This is common. Then C for control. C for control. What type of controls? What type of control we have? This is also common in both the places, slight difference is there. So in case of GST, one point is there which says that single shareholder holding greater than or equals to 25% in two companies. There are two companies. In those two companies, there is a single shareholder. That single shareholder is holding 25% or more in both the companies. So now those two companies will be treated as related. Okay. Whereas in customs there is a change, that is 5%. Okay. There is a change. Single shareholder holding greater than or equals to 5% in two companies. 5% in two companies makes those two companies as related. Okay. Then another control is there which is common. Okay. So first is two companies having same shareholder holding 25% or more. Here it is 5% or more. Then another point in control is there, that is one person invests greater than or equals to 51% in another. This is common in both the places. Then we have common control by a third person. Common control by a third person. Common control by a third person means, so that is two companies having the same parent company, like two individuals having same father but different mother, like that. So common control by a third person. Next, then we have together joint control of a third person. What is the difference between these two? Common control means, say X Limited, Y Limited. Both X Limited and Y Limited are under A Limited. Now, as these two companies are controlled by a single company, so these two companies are treated as related. That is common control. Joint control means together they control a company. For example, two shareholders you take. These two shareholders cumulatively holds more than 50% in the company. Now these two shareholders are also treated as related. That is this. So family, slight change. Yes, sole selling agent same. Control also, total 4 points in control. In that, two companies, single shareholder 25% or more. Next, one person investing greater than or equals to 50%, 51% in another. Okay. So why 51%? Because equal to I used. Suppose if I remove this greater than or equal to, can we make it as greater than 50%? Yes, greater than 50% we can make. For example, 50.1%, 50.5%. Control is there definitely. Okay. So greater than 50% in another. Common control by a third person. Two companies which is having a common control, common companies controlling these two, or joint control, that is together they control a third person. Then O for officers or directors of one another's person. Officers or directors of one another. Officers or directors of one another. That is, I am appointed as officer in your business and you are appointed as officer in my business. Now we both are treated as related, that is officers or directors. Then P is partners of a legally recognized firm. Partners of a legally recognized firm. Then E for employer and employee. Employer and employee are also treated as related. So this is the meaning of related in both the places. So maybe anywhere it will be useful. So that's the reason why we have made note, and you remember it easily like this, related definition. And because we don't have to write the entire definition, only thing we need to know whether they are related or not. So in GST also anyhow it will be useful. So together we discussed, only difference is that family is defined in GST but not defined in customs. And in control point, so two companies having a common shareholder, so 25% or more in GST, whereas in case of customs it will be 5%. So that is these points. And you can see here meaning of related in the context of customs is same as the meaning of related in GST, except that in customs person holding 5% or more equity in 2% make them related instead of 25% or more in GST. Okay. Next, declaration by the importer or exporter, that is importer or exporter or his agent shall furnish a declaration disclosing full and accurate details of the value of imported or exported goods, and this rejection of declared value, I told you already, proper officer to reject the value of imported goods or exported goods declared by the importer or exporter if he has, when, doubt about the truth and accuracy of that value, and it shall be deemed that the transaction value of such imported goods or exported goods cannot be determined under rule 3, which means that so a value needs to be determined as per other rules. That is about this. This is common between both import and export. With this we completed valuation under customs.